Buy your gold and silver from SD Bullion. Right now, new customers can buy gold or silver at spot by visiting sdbullion.com/new. Hey everybody, Smart Silver Stacker here. Hope you're doing well. We got to talk about inflation because it's moving up once again. Not that it ever went anywhere to begin with, but the narrative of disinflation, of prices returning to some kind of normalcy, some normal pace of increase. It's coming to an end because we just got the CPI data from December, last CPI reading of 2023, moving up more than expected. Surprise, surprise. Probably not more than you and I expected, but more than the economist polled had expected. So we got the December CPI up 0.3% month over month. 3.4% year over year. That is an increase from 3.1% in November, and it's also 0.2% higher than analysts were expecting. Core CPI, that is excluding the volatile food and energy categories, up 3.9% year over year compared to 3.8% expected. Here's the press release from the Bureau of Labor Statistics, and as you can see, pretty much everything up except for energy. So far, energy is the thing that is really saving the powers that be here from much higher inflation. That's probably going to change, as we'll get to here in just a moment. But first, let's talk about the other items on here. So goods are good, or rather goods are rising in price. I think one of the few things down was used vehicles, just about everything else up. Food hitting an all-time record high of high prices, so that's not good. You know, the stuff that we actually are forced to use, rents were up, housing costs up, pretty much everything up except for energy. You can see here, this is the chart of the year-over-year rate of change, like month to month here. So every month it tells you what the year-over-year rate of change was coming down here in 2023 for a bit. We saw this decline. Now it's ticking back up, and this disinflation narrative that we've been sold is starting to look not so accurate any longer. It's kind of like how inflation was transitory, you know, the disinflation was here. Oh, it appears not to be. And you can see that kind of illustrated more on this chart of the month-to-month changes. So you can see in October, that was the month that the president told us we had no inflation. Well, that changed, and you can see now it's on the rise once again. So, you know, what does this mean for gold and silver? What does this mean for the Federal Reserve? Markets, I believe, are getting it wrong. But of course, you know, it's no surprise. This is kind of what we would anticipate in this Fed-driven market. We have got high inflation leading to lower gold and silver prices. Gold down $8 on this news. And you can see it kind of was hanging tight for a little bit. The data was released at 8:30. Gold kind of stayed flat on the day, but then as we've moved through the trading session, we've seen it come down. Same story for silver. I mean, it's just incredible how markets get this so wrong. But, you know, why are the prices of the precious metals falling? Well, it's because investors now are convinced that the Federal Reserve, they're going to be more committed to their inflation fight, and they're not going to be printing more money. They're not going to be cutting rates. They're not going to be easing, or at least they'll be less likely to as a result of this. I couldn't disagree with that more because this data-dependent Fed that we have, I think when push comes to shove, they are going to run the printing presses. Let's take a look at the CME FedWatch tool. You can see earlier in the day, this anticipation of a rate cut, the March FOMC meeting was around 69%. Now it's down to, we got 63.3% anticipating a quarter 25 basis point rate cut in March. Only 1.7% now anticipating a full 50 basis points rate cut in March. And I mean, who knows? Nobody knows when the Fed will cut. Nobody knows when the Fed is going to begin easing. But I think if the Fed begins sending messages that they're not pivoting, as we were told at the end of 2023 when Jerome Powell told us that we would have several rate cuts here in 2024, if they change their tune on that, it's going to collapse the market that we have. It's going to collapse commercial real estate. It's going to collapse the rally in stocks that we've seen towards the end of 2023. And I don't think there's any chance they're going to let that happen in an election year. Of course, gold and silver, however, I mean, it's just incredible how undervalued they are. I mean, silver, at $22. I want to talk about this real quick. Look at this. This is the chart of Newmont Gold. This gives you an idea of just how pessimistic right now investors seem to be on the precious metals. The world's biggest gold miner here. This is the 5-year chart going back 5 years. Right now, it's valued at $37.40. Now, look at where it was back in April of 2022, up around $85. Now, where was the price of gold at that time? Where was the price of gold in April of 2022? It was just under $2,000. So, today we have gold over $2,000, and yet the world's biggest gold miner at less than half the price from when gold was at 1970. So, what does this tell you? I think it tells you that investors have no clue what is coming in 2024. I mean, sentiment towards the precious metals is incredibly low. Sure, gold is high, but the miners, silver, incredibly undervalued at these prices. And let's talk about why the Fed is just going to have to print no matter what happens with inflation, and why inflation is going to be going much higher. The inflation fight is done, if you ask me. First of all, BTFP, won't stay on this too long. This is emergency lending facility created last March when banks started to fail. That whole banking crisis brought about by Fed rate hikes and the subsequent increase in U.S. Treasury rates, which had caused all of the treasuries sitting on the balance sheets of these regional banks to devalue because they're low yielding. The banks being forced to use these treasuries, which have these huge unrealized losses. They got to give those to the Fed as collateral for loans. The Fed's loaning them money at face value, way more than the bonds are actually worth in the market. Basically, it's QE by another name, the Fed buying up treasuries, because what motivation do these banks have to pay back these loans and get these crappy devalued treasuries back, the collateral they put up? I don't see it happening. And you can see that this has been hitting record highs every week since the end of November. We're now up to $141 billion of these loans. And all of this whole crisis brought about by high interest rates on the part of the Federal Reserve. Now, let's take a look at this. Delinquency rates on credit card loans. This is kind of a proxy measure of the stress being put on consumers. Why high interest rates are hurting consumers. Well, this doesn't look so bad. You've got the data from Q3. We'll be getting, I believe, the updated data for Q4 sometime in the beginning of February, so that's going to be interesting to see. But anytime this gets brought up with the president or with the chairman of the Federal Reserve, they always say, well, these rates are historically low. They're just near pre-pandemic levels. No big deal. Nowhere near the height that they reached in the great financial crisis. Not a problem. Well, look at the year-over-year percentage rate of change in delinquencies. That kind of puts a different picture on things. You can see delinquencies rising at the fastest rate in terms of percentage increase on record, going back to the early 1990s. So, I mean, this narrative of a strong economy and falling inflation is complete nonsense. I mean, what we have is a threadbare economy being held together by deficit spending and massive amounts of borrowing, and that is starting to fall apart as the Fed has embarked on this program of rate hikes, and they've maintained rates so high. So, they're going to have to cut, just like Powell was telling us in December and at the end of 2023. Despite whatever, inflation reports come out, Fed tells us they're data dependent, but I think we know when push comes to shove, they're going to print and they're going to bail out the economy. Back to this chart, this again showing that energy, really the only saving grace in terms of inflation that we have right now, a declining price of energy. Well, look at this news that we got today. I don't think that's going to last very long with the way things are going in the Middle East. Oil tanker embroiled in U.S.-Iran tensions is boarded off Oman. Am I saying that right? Oman? I think so. So this ship was seized by Iranian forces. I say masked men have seized it. It's now headed towards an Iranian port. Previously, this ship was one that was seized by the U.S. 1 million barrels of Iranian oil was seized. The ship's owner, I think, was convicted or fined or something like that for transporting sanctioned Iranian oil. Well, now it had 1 million barrels of Iraqi oil that was destined via the Suez Canal for Turkey, and it has now been seized and headed to Iran. So it looks like maybe they're taking their oil back. On this news, we saw a significant rise, oil up now 2.3% on the session. And so we have, these opposing forces at work in the energy market. One, you have a global economic slowdown, a decline in demand, U.S. record production. You have the Saudis recently cutting prices on their oil, trying to maintain market share. But at the same time, you have this threat of a major escalation in the Middle East. And this is very notable where this took place. So this took place off the coast of Oman. And if you'll notice here, so far, we've had these supply disruptions in the Red Sea, container shipping being rerouted. The Houthis in Yemen here, just south of Saudi Arabia. So this is where we have really seen the problems so far with shipping. Well, this took place in the Gulf of Oman, much closer to this area, the Straits of Hormuz. And this is a critical juncture, a critical transportation route for crude oil. Something like 20% of global production of crude oil goes through the Strait of Hormuz. And you'll notice it's right next to Iran. So if you now have transportation disruptions to oil tankers transiting the Straits of Hormuz, that is going to be far more inflationary than what we have seen so far with Red Sea shipping lanes. I mean, both critical shipping lanes, of course. You got the Suez Canal over here. They were supposed to be sailing from Iraq here through the Strait of Hormuz, through the Gulf of Oman, around here, through the Red Sea, up through the Suez Canal to Turkey. But you can see the problems with that route going through this area that is so close in proximity to Iran. They can shut down the Strait of Hormuz when they like. And the fact that they have now seized an oil tanker, I mean, in and of itself, this probably wouldn't be that big of an escalation. But when you put it against the backdrop of the conflict that is raging in the Middle East, potentially expanding to involve Iran, this is a big escalation. And I don't know what the escalation is going to be that ultimately spikes the price of crude oil. With the way things are, I mean, things are a powder keg. I would imagine that it would not take much to create a significant disruption. I mean, we're very close to that. And I don't think the price of energy is going to be staying lower for the duration of 2024. I mean, I don't have a crystal ball. I don't know. Hopefully, cooler heads will prevail, because if they don't, it's going to be a big problem for everybody globally in terms of inflation. It's going to drive the price of everything up. But that isn't going to, just because I want that to be the case doesn't mean that that's what we're going to see. And I think signs are pointing towards global energy market disruptions here for the remainder of 2024. And again, this chart shows that inflation is done coming down. The disinflation, I believe, that we've heard so much about is over. I think we could even see a second spike of inflation like we saw in 2022. Here in 2024, we could see round two. It's an election year. And, I think we're going to see all sorts of crazy messaging surrounding inflation. We might see more things like the aptly named, Inflation Reduction Act. I'm sure that did very little to reduce inflation. And I wouldn't be surprised if they, start running the printing presses and tell us that it's to fight inflation. If U.S. consumers who are increasingly delinquent on just about all forms of debt, whose savings have been wiped out, who are relying more on credit cards than ever before, if they start getting checks in the mail that are inflation relief checks, I mean, the world is crazy, is total clown world economics. But I would not be surprised if we see that sort of thing. And ultimately, I think the price of gold and silver, of course, are going to soar when this all plays out. The other thing you can expect, the U.S. national debt now at $34 trillion and growing. Should the regional war there break out, that's going to be a huge problem. This basically, the national debt guarantees that much higher inflation is on the way, whether this year or beyond, because ultimately all of this debt is going to have to be monetized as relations between the U.S., the West, the G7, and the rest of the world break down. There's going to be less buyers for this U.S. debt globally. And so who's going to buy it up? Well, it's going to have to be the Federal Reserve. So, expect inflation to keep moving much higher. I'm going to take this drop in the price of gold and silver as an opportunity to get into more inflation hedging assets. Look, people are going to say, gold and silver clearly aren't inflation hedges. Look, inflation is being driven up and gold and silver are falling. Well, look, there's only so long that the Fed can control market perceptions. And until they do, gold and silver, or as long as they do, gold and silver probably will remain undervalued. But you can look at the math and understand that ultimately much higher inflation is baked into the cake unless the Fed and the politicians allow the economy to collapse. They allow a U.S. debt default. When you spend all this money, this deficit spending, there's only, a couple of ways to get out of it. You can pay it off. I don't really see that happening. You can impose massive austerity and raise taxes and, pay it off the old-fashioned way. You can default on it. We know how bad they make that sound. And it's sure a debt default would be bad, but probably what we're going to get is the worst alternative, which is an inflationary default. It's just paying off this massive debt with devalued currency. I really think that is on the way. Let me know what you think in the comments down below. Thanks for watching, everybody. Stay safe and happy stacking. I'll catch you next time.